Core explanation. Part 2. The myths and misconceptions of quant trading. Let's get one thing straight. Most people think quant trading is some kind of mystical black box, a magic formula that spits out money on autopilot. But that's a myth. Even Jim Simmons, with his army of PhDs and cutting-edge algorithms, faced massive failures before unlocking consistent success. Renaissance Technologies wasn't built overnight. It took decades of trial and error to refine their approach. So let's break down some of the biggest misconceptions about quant trading and reveal what actually works. Myth number 1. You need supercomputers and a billion-dollar budget. Most traders hear quant trading and think of a high-tech hedge fund running on hyper-advanced AI. But here's the truth. Simmons didn't start with a billion-dollar budget. He started with math, data, and an unconventional mindset. Even today, the core principle behind his system, finding repeatable statistical edges, can be applied by individual traders. You don't need a PhD or a supercomputer. You just need the right approach. Look for patterns in historical data, not news headlines. Focus on probability, not predictions. Test everything. Never assume a strategy will work just because it sounds good. Most traders lose because they get emotionally attached to their strategies. Simmons didn't. If a system stopped working, he scrapped it. No hesitation, no ego. Myth number 2. Fundamental analysis is king. Traditional investors swear by fundamental analysis. Earnings reports, macroeconomic trends, CEO interviews. But Renaissance Technologies prove that market movements don't always follow logic. Think about it. If markets were rational, why do they swing wildly on rumors? Why do stocks sometimes rise after bad news and fall after good news? Simmons found that markets move based on hidden statistical tendencies, not just fundamentals. For example, price action might reveal that a stock has a slight tendency to rise after a certain type of drop, even if there's no logical reason. A quant trader doesn't ask why. They just ask, does this pattern repeat consistently? If yes, they trade it. Myth number 3. The market is completely random. The efficient market hypothesis, EMH, claims that markets are unpredictable, that all available information is already priced in. But Simmons' Medallion Fund proved otherwise. If markets were completely random, Renaissance Technologies wouldn't have beaten them for 30-plus years. What Simmons discovered is that while short-term market movements look random, they contain micro-patterns that repeat just often enough to be profitable. The key isn't trying to predict big moves, it's capitalizing on small, repeatable inefficiencies before the rest of the market catches on. The hidden challenges of quant trading. Now, before you think quant trading is an easy way to print money, here's the reality. Even the best models break down. Jim Simmons faced major obstacles in building his empire, including models that worked in backtests but failed in real trading. Many strategies look great on paper, but fall apart in live markets. Unforeseen market shifts. Algorithms that thrived in one market condition could collapse when volatility spiked or trends reversed. Execution issues. Even if you have a winning strategy, slippage and transaction costs can eat into profits. So how did Simmons overcome these problems? He constantly adapted. His team didn't just build one magic system and let it run forever. They relentlessly fine-tuned their models, adjusting for new market conditions. This is the real secret of quant trading. Constant iteration, ruthless testing, and zero emotional attachment to any strategy. How Simmons turned obstacles into an unstoppable system. Here's where things get really interesting. Jim Simmons didn't just build a trading system. He built a self-learning machine. Instead of manually adjusting strategies, his fund developed algorithms that could detect when a model was breaking down and automatically adjust to new conditions. It was like a financial AI that evolved in real time. This is why Renaissance Technologies has continued to dominate for decades, even as markets change. Their trading models don't rely on outdated theories. They adapt, learn, and refine themselves. So the big question is, can individual traders apply these same principles? The answer is yes. And in the next section, we'll break down how you can start using quant-inspired techniques to improve your own trading without needing a team of mathematicians or a billion-dollar hedge fund. How to trade like a quant without a billion-dollar fund? Jim Simmons built the most successful hedge fund in history by mastering probabilities, not predictions. But here's the exciting part. You don't need a PhD or an army of computers to apply the same principles to your own trading. Let's break down how you can use quant-inspired strategies to sharpen your edge in the market today. The answer is yes. And in the next section, we'll break down how you can start using quant-inspired techniques to improve your own trading without needing a team of mathematicians or a billion-dollar hedge fund. How to trade like a quant without a billion-dollar fund? Jim Simmons built the most successful hedge fund in history by mastering probabilities, not predictions. But here's the exciting part. You don't need a PhD or an army of computers to apply the same principles to your own trading. Let's break down how you can use quant-inspired strategies to sharpen your edge in the market today. Step 1. Think like a casino. Focus on small, repeatable edges. One of the biggest mistakes traders make? Going all in on a single trade because they feel it's a winner. Simmons never did that. Instead, he played the numbers like a casino. Casinos don't win every game, but they win over time because the odds are in their favor. The key is not predicting individual outcomes, but exploiting a consistent statistical advantage. Your action step. Instead of chasing home run trades, start analyzing your past trades. What setups give you even the slightest edge? 51% plus win rate? Focus on trading those repeatedly with discipline. Next, step 2. Track and test everything. Data greater than opinions. If Simmons taught us one thing, it's this. What you think works doesn't matter. What actually works does. Most traders jump from one strategy to another without ever measuring performance. Simmons and his team tested everything, every pattern, every inefficiency, every idea, before risking a single dollar. Your action step. Start keeping a trading journal or use software to log every trade. Look for patterns. Which trades win most often? Under what conditions? The answers are in your own data. Step 3. Remove emotion. Automate your decisions. Jim Simmons didn't let fear or greed dictate his trades. His computers executed strategies without emotion. The good news? You don't need a hedge fund to do this. Your action step. Create a set of strict trading rules. Entry, exit, position sizing. Write them down. Follow them like an algorithm. If a trade doesn't meet the criteria, don't take it. No exceptions. Want to go further? Use automated alerts or even simple trading bots to execute trades for you based on your rules. Step 4. Backtest before you risk money. Simmons' team spent years testing strategies on historical data before putting real money on the line. Why? Because the market doesn't care about your opinions. It only cares about probabilities. Your action step. Before using a strategy, backtest it. Look at how it performed in different market conditions. Would it have worked in the last crash? During a bull run? If not, adjust it before trading live. Many trading platforms offer backtesting tools. You don't need a supercomputer to do this. Step 5. Adapt and improve. Never get attached to a strategy. Markets evolve. What worked last year might fail tomorrow. Simmons' biggest edge wasn't just finding patterns. It was constantly updating his models. Your action step. Every few months, review your strategy. Is it still performing? If not, tweak it or scrap it. The best traders stay flexible and adapt. Jim Simmons' success wasn't luck. It was discipline, data, and a relentless focus on small, consistent advantages. Most traders lose because they follow emotions, opinions, and predictions. Quant traders win because they follow numbers, probabilities, and rules. So ask yourself, Are you making trades based on gut feelings? Or are you acting like a casino, stacking the odds in your favor and executing with precision? In the final section, we'll tie everything together with key takeaways and a thought-provoking conclusion. Let me know when you're ready. So, what's the real lesson behind Jim Simmons' $100 billion empire? It's not about finding some magical formula that predicts the market. It's not about gut instincts, news headlines, or following the latest hype. Simmons cracked the market's hidden code by doing something radically different. He stopped trying to predict and started measuring. Recap of key lessons. Let's go over the core principles that made Renaissance Technologies the most successful hedge fund in history. Small edges, big profits. You don't need to win every trade. You just need a small statistical edge, executed with precision over and over again. Data over opinions. Forget predictions. Test everything. Track your trades. If a strategy doesn't work consistently, discard it. Emotion kills, rules. Win. The best traders think like machines. Set your trading rules in stone and follow them no matter what. Adapt or die. Markets evolve. Your strategy must evolve too. Constantly refine and test. Never get attached to what worked in the past. The final question. Now, here's the part where most traders fall short. They hear this, they get excited, but they don't take action. So the question is, are you going to keep trading based on emotions and opinions? Or are you ready to approach the market like a quant? Because right now, the tools are in your hands. The markets will keep moving, patterns will keep forming, and those who apply these lessons will be the ones who consistently stay ahead. If you found this breakdown valuable, hit that like and subscribe button, and please share your thoughts in the comments. Have you ever tried a quant-style approach? What trading strategies have worked best for you? Let's discuss. And if you're ready to take your trading mindset to the next level, make sure to subscribe, because we're just getting started. Until next time, trade smart, think in probabilities, and remember, the market doesn't care about your opinions, it only cares about your edge.